Hey, welcome back, folks. The Dave Clark Five and Gene Pastula in studio, who used to act so old he used to play for the Dave Clark Five. Gene Pastula, ladies and gentlemen. Oh, you have your own intro music now, huh?
Of course.
Welcome back to the show. Gino, 844-RAY Show. If you have a question for Gene Pastula, who's taking some issue with me, which is fine because, you know, he and I talk and debate and go back and forth, and I'm not going to necessarily disagree, but I'll give you your time on the floor here. Before the break, I said, you know, people that are saving for their retirement ought to certainly take advantage of the free money with their 401k matching contribution. And then I said, stop, jump over to the Roth IRA, stop after you've max fund that, and then jump back to the 401k if you need to still save. And then if you still have money left over, perhaps use an indexed universal life policy. I think that's where you, an indexed universal life expert, would possibly disagree, or are you kind of in the same camp? Where are you on that?
Well, I would probably check that out first before the Roth, particularly in the situation that you were describing, where you have a younger person, obviously, which is where all this thing really applies to the max. I would look at the insurance contract, because probably that individual has other needs for the life insurance portion of it. And these products are basically, as described and as we're discussing here, are not designed to create a huge amount of life insurance. What they are is they're designed to use the life insurance and the tax implications and features of it to accumulate money on a tax-free basis and then distribute it tax-free in retirement. And of course, that sounds a great deal like a Roth, doesn't it?
It does indeed, yeah. And you'd be just so pleasantly surprised that I finished my book on this very subject. So it's not. I mean, I always like to, you know, tease you and then set you up so that you have something to talk about when you come on the program. Otherwise, you sit there, you know, and listen to Rocky.
All the way up here, I was wondering, what am I going to talk about?
I wonder. Gene, who has not had a difficult time spewing out anything, most of which is important, but there's a few times. No, I won't go there. It is kind of interesting, though, because Index Universal Life has gained a lot of momentum and a lot of popularity over the years. Is that because the products have become that much more competitive, or is it because people are starting to recognize the tax benefits, the death benefits, the health care benefits associated with an Index Universal Life versus a Roth IRA, which gives you phenomenal tax benefits, but that's just about it?
Yes. Oh.
You have the floor. If you want me to explain it, I've written a whole book on it.
What they should understand is that the idea of using these products is, when you're talking about insurance, everybody thinks in terms of, okay, you know, I don't need a bunch of life insurance or what have you. But the point is that the insurance contract has these tax benefits built into it, and the universal life aspect of it allows us to accentuate the features that we want. And in this particular case, we don't want so much life insurance. What we want is more buildup of the cash, the equity portion of this, so that ultimately we can use it for retirement. So when you do this, the advantage of it is that it offers an opportunity to get a particularly high interest rate relative to other alternatives safely, with no tax on the accumulation, and then to access that money in retirement without tax. Most importantly, all of this without any specific government stops on you know, how much you can put in, or how much you can take out, or when you must take it out, or how long you have to leave it. All of those things that we get involved with every time we get involved with a government plan, this has none of that. So when you set them side by side with a Roth, and then also you know, take into consideration that, all right, I've started this when I was 40. At 57, I develop a heart condition and end up passing away, and the insurance company adds another $100,000 to my cash account versus the Roth that doesn't add anything, it starts looking really, really good.
Well, and you're right, no doubt, and we can debate it, and I can, as I've said many times before on this program, you give me this pen last, I can probably win the argument. So it's all debatable, but it's all individual too.
Yes.
Because if a person doesn't have a need for any insurance at all, then that might dictate one way or the other. But there are some things in the Indexed Universal Life that I do write about in my book. If you'd like to have a copy of it, by the way, it's an ebook. I'll send it to you, no cost, no harm, no foul. It's called The Undiscovered Savings and Retirement Plan, and I get into a lot of the detail. But there's a couple of things here. Number one is, let's say you were putting money into a Roth IRA, as we've advised many times, that individuals, rather than put money into a 529 plan, where, you know, if the kid gets a scholarship or whatever, there's a 10% penalty if you use the money, blah, 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 blah. You can put the money into a Roth IRA. But if you put that same amount of money into an Indexed Universal Life and you use that money to fund college, one thing that's interesting, and I do cover this in the book, is with borrowing money from, say, a life insurance policy, you can always pay that money back as if you didn't terminate your savings plan. If you cash in your Roth to fund, whether it be a down payment on a home or kids' college tuition or whatever, you can't put that money back. You start over again at $5,500 contributions. That is actually a big, huge advantage. And I'll give you one.
I didn't even think of as I was talking earlier.
Well, you
yes.
see, you should read my book and learn all about this stuff.
Well, I want to be the first one to get a copy.
Okay, well, you will not be the first one to get a copy,
I'm sorry.
but you'll be in the top 10.
Okay, good. But the other thing is that and you made the point, is that there's no limit to how large of a plan that you set up.
That's right.
We just did one just recently for someone up in Northern California for $55,000 a year. This individual is putting into these things. With no way you could do that with a Roth IRA. And I would say the one area where you were right relative to
the one area where I was right.
Profound area that you were right when you're first laying out of these priorities is if you're really an investor and you don't want money any place but in equities to get, and really rock and roll and get the best rates of return, then the Roth is probably going to do a better job for you. But the interesting thing about the index products in life insurance now is that because they use stock market options to invest, you get typically a higher rate of return than you would with other safe money like banks and bonds and that sort of thing. So it's sort of a midway point between the equities in your IRA and the your savings account or what have you.
Well, there's one other benefit that when we come back from the break, I'll explain and see if Gene thought about this one. All right, because he thinks about almost everything.
Almost.
Okay, so the two of us will come back and visit more on this subject. We're also going to talk about healthcare. Boy, there was just a scary stat that came out just the other day on post-retirement healthcare and Social Security. We'll check in with Gene on that, see what he has to say. And we'll also see what you have to say. If you want to chat with Mr. Pastula, give him a buzz right now, 844-RAY-SHOW. He usually comes with a buzz, but give him one anyway.
Telephone is ringing.
And we're back, the Ray Lucia Show. Glad you're here. 844-RAY-SHOW. If you want to email me, we'll get to a couple of emails here momentarily. RayLucia.com, RayLucia.com. Just simply click on the Ask Ray button and Ray will respond. Gene Pastula back with me, as he is every week, talking about one of his favorite topics, using life insurance policies as a savings medium. And I don't think we're disagreeing. I think we're pretty much in sync that there's certainly nothing wrong with putting money into 401ks or Roth IRAs or indexed universal life insurance policies, in particular if you're a younger family and have a need for coverage. And how many younger families don't have a need for coverage? One of the things I wanted to ask you, though, Gene, before I get into this other, I think, element of an indexed universal life that a lot of people don't realize is so many people ignore, I think the stats came in a few weeks ago, that people today, in particular younger people with families, are buying way less life insurance. to protect their family. To me, that is a dangerous proposition, especially in light of the economic conditions that most families are in today, and our economy just in general is not nearly as healthy as it once was. Interest rates are at historic lows. What are you going to do? Leave a spouse with virtually no money or $100,000 and they got to live for the next 20, 30 years, educate the kids? So why is it you're in that business that people are buying less life insurance?
I have no idea why, but I know that that's always been an issue. I mean, I've been around that business now for over 40 years, and it never has changed. Obviously, when one knows that they are, or one fears that their mortality is in jeopardy, they're going to die, they want the insurance.
Yeah.
I mean, we get calls from time to time that it's, in fact, the only time somebody calls and says, I'd like to buy some insurance from you.
Why not?
Yeah. Well,
What's
we
wrong with
know
you?
that person, is going to not be around for a while. But of course, all of a sudden we want it, and insurance is something that you're never motivated to do anything about until you see that event on the horizon, and the closer it is, the more you want it. And I mean, think about it. There's a law that says you have to be properly insured to drive a car. There's a law that says you have to have, not a law, but a requirement by every lender that wants insurance on your house. And I'll bet they wouldn't sell half of the amount of insurance that they do if those laws weren't in place. Well, okay, the other two major ones are health insurance and life insurance. Health insurance, we always have an event on the horizon. You never know when you're going to get sick.
And now there's a law that says you have to have it.
And now they even put a law for that, So,
Good point.
Then the other one is life insurance. And so the interesting thing to me, though, is that life insurance, particularly for young people, to buy term insurance for 20 years is so inexpensive. I mean, the average young dude spends probably more on new Game Boy apps, to sit around and relax with, than it would cost to buy $1 million of insurance.
Well, that's true.
I don't really know what the cost of a Game Boy app is, but
I don't even know what a Game Boy is. So there you have it. I'm way out of it.
I just made that up.
Oh, you did? Okay, good.
No,
I think it's a little handheld device. That I don't know what they play on
the TV or
but
something.
I think Nicholas plays one of those all the time when he comes over to my house.
Yeah,
but then
well,
he gets my iPad, and he knows how to order apps online and all that stuff. And
that's what I was talking about.
Okay.
So anyway, in fact, we've got it now set up so that people can go on actually, we don't have it until next Friday, on our website, where people can go on and they can do it all themselves. I mean, what are you talking about? How much do I have to pay, and how much are you going to pay my beneficiary when I die? And so you plug in a couple of things. The program rates it for you, and then gives you 12 different insurance carriers, from the lowest cost to the highest on that 12. We've got 40 in there. That gives you all the options of buying the insurance, and you just pick the one you want, hit the other button, answer a few questions, hit the button again, and next thing you know, there's some nice lady is going to call you from I don't know where, and take the information on your application. And then the next thing you know, you'll get a policy in the mail. And if you want some help, you can also push another button and get, I don't know if me or one of my associates to answer questions, etc. It's so simple. You don't have to have some dude coming out to your house.
But what people don't realize, because I hear these ads for dial 1-800 and you get cheap term and all that stuff. The costs are the same. I mean, there's no benefit in calling some 800 number and buying from some licensed agent, but by the same token, they give you the impression that you're buying a no-load life insurance policy. When you buy a term policy, you're paying for term. Yeah. Right? And so there's no difference.
And all of the advertisers that you hear are basically operating off of pretty much the same list of carriers. And when you get down to that, I mean, when you get down to the top 5, you're talking about maybe I don't know, $20 in a year difference from one policy to the other. I mean, it's just not that big a deal. Where the deal is, and where some help would be of value, depending on your circumstances, is the amount of options that you have with that policy going forward. And for example, can you convert it into a linked benefit product when you get older? Without having to prove insurability. So, when you buy the thing at 40 and now you're 60, and I guarantee you that there's like a 90% chance that your health will not be the same as it was at 40. And if you can just go ahead and convert that policy that you bought at 40 with the preferred rates without having to prove any health or anything else, that can be an extremely valuable situation. Some of the policies that you can buy through the online or over the telephone, people have that feature available, and some of them don't. So knowing which ones do and knowing whether or not that's a good option is important.
Okay, Gene Pastula, my special guest. SafeMoneyMonitor.com, by the way, is the website you can go to. SafeMoneyMonitor.com. Now, I told you before the break that I was going to mention one other very, very unique potential, I should say, advantage to an indexed universal life policy. One of the ones I had mentioned is, other than a Roth IRA, which is a great way to save on a tax-free basis or tax-deferred, ultimately tax-free basis. But the indexed universal life gives you the same option by accruing money on a tax-deferred basis, then allowing you to borrow funds later on at fairly low interest rates, and that's where I'm going to go. But I said you could always pay that money back and have a much bigger retirement plan rather than have to start all over at $5,500 per year, $6,500 if you're over the age of 50, in funding the Roth IRA. But a lot of people say, I don't want to borrow money, I want to borrow money. Well, what's unique, one of the unique features of a life insurance policy, an indexed universal life policy, is many times they have loan rates that could potentially be under the earnings rate. We talk about this in real estate all the time. It's called potential positive leverage. In other words, if I can borrow money to go buy a piece of real estate at 4%, and on an all-cash basis, that property gave me a 6% yield, then I'm actually making 2% on the money that I borrowed. Positive leverage. One of the things that's interesting about a universal life policy, an index policy, is if you earn 6 and you borrow at 4, that 2% continues to accrue, and you're earning that interest each and every year, meaning you may be able to withdraw a greater percentage than if you didn't have positive leverage, right?
Right. And when you look at an illustration that shows you're putting your money in, and then the amount of time you're taking it out, that factor will come into play depending on the interest rate assumptions that you're using to adjust the amount of income that you're going to get tax-free over time. It's pretty impressive, quite frankly, and it's not a lot of magic. And they've been doing this now. I mean, the concept has been done for ever since I've been in the business. I mean, and perhaps longer. Although I can't imagine anything going on before I was around. No. But the fact that we now have this indexing ability in a life insurance policy creates a lot more options for benefit.
If you want to learn about this and get a copy of my book, you can go to raylucia.com. Just ask me, and I'll shoot you over to safemoneymonitor.com. If you just want to get one of those quotes or just talk with Gene, SafeMoneyMonitor.com. He does it all, and he makes available these products and services to thousands of insurance brokers all across America. So he's got everything in his back hip pocket. Gino, thank you, buddy. Nice job today.
My pleasure.
All right, and we didn't.
Last week wasn't
You were
so
average
good?
last week, but this week you're much, much better.